I've said for years now that silver was the fuse that would blow up the gold's derivative bomb, if you will, and that immediately spills over to credit markets. So it was a way, suppressing gold and silver was a way to support, if you will, the dollar, and also, most importantly, the ability of the U.S. Treasury to borrow. Once you see a failure to deliver in silver, within 72 hours, it's pretty much game over.
We see these new tariff wars have sparked a move to switch from price suppression to draining cheap silver. They're going all in, stepping in, building up the strategic silver stockpiles. And again, Sun Tzu style, they're currently being drained from its enemies. They are enemies, and they want to remonetize silver. And they've remonetized gold, they're remonetizing silver. Why? This is hell for the West.
Registered silver, the metal officially available for delivery, has reportedly fallen about 16% over the past month. The surge in silver prices during early 2026 is driven by a perfect storm, where chronic physical shortages have finally broken the traditional paper pricing system. Financial commentator and precious metals analyst BillHolter and AndrewMaguire provide insights on physical bullion demand and global pricing dynamics. BillHolter warns that a potential failure to deliver physical silver against futures contracts could reveal serious weaknesses within the global financial system. For decades, the prices of gold and silver have been restrained through derivatives markets to preserve confidence in the US dollar and enable the government to finance large amounts of debt at lower cost. According to Holter, keeping precious metals subdued helped reinforce the perception that fiat currencies are stable while discouraging investors from seeking refuge in hard monetary assets. Recent market trends highlight tightening conditions in the silver sector, as the global market is expected to run its sixth consecutive supply deficit in 2026. Meanwhile, AndrewMaguire mentions that the structure of the silver market has already begun to change. In recent years, instead of contracts disappearing before delivery, more traders are now choosing to stand for physical delivery throughout the month. Maguire note the growing demand for real metal, especially from markets like Shanghai Gold Exchange, is shifting price discovery toward physical exchanges rather than purely paper trading venues. Both analysts suggest that if delivery demands continue rising while available exchange inventories remain limited, the silver market could face increasing stress. They believe this shift toward physical settlement may ultimately reshape how precious metals are priced globally. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from BillHolter's recent interview with AndrewMaguire.
We're looking at ultimately a failure to deliver. And a failure to deliver, I've said for years now that silver was the fuse that would blow up the gold's derivative bomb, if you will, and that immediately spills over to credit markets. It must be understood that the reason gold and the reason silver have been suppressed since 1975, since they started futures contracts on the metals, the reason for the suppression is to allow, or was to allow, the financial world, the media, to point at gold and say, see, gold bad, dollar good. And a low gold price allowed the U.S. government basically to borrow unlimited amounts of capital. Had gold been left to its own and traded to levels, multiples probably of where it is right now, that scares money away from U.S. credit. So it was a way, suppressing gold and silver was a way to support, if you will, the dollar, and also, most importantly, the ability of the U.S. Treasury to borrow. Once you see a failure to deliver in silver, within 72 hours, it's pretty much game over, because the entire derivatives edifice is going to crumble, because credit/derivatives are based on trust, based on confidence. And if you fail to deliver on a contract, it displays to the world that contract was a fraud. And if you've got fraudulent contracts out there, you're going to have capital fleeing, looking for a safe place. And that safe place just happens to be gold and silver that they've suppressed for so many years because they can't bankrupt. They cannot default in a world that is in the process of defaulting. Well, I said watch out for the March delivery month simply because the game has changed. It used to be that, and I'll just use the number 100. It used to be 100 contracts would stand for delivery on first notice day. And by the time it came to deliver, there might only be 6 or 7 or 3 or 12 contracts that actually stand for deliver. They all got basically paid in fiat to walk away and not take the metal. Now, over the last year and a half to 2 years, that has changed. The number that you see on first notice day, that number now grows during the month. So whatever stands initially stays, and then you've got new contract buyers that step up, buy the contract, and they stand for delivery. So you saw, I think the number was 30 million ounces in January. I think we're about 25 million ounces here in February. And this is versus basically 100 million ounce registered inventory that's available to deliver. And as of right now, there's a shade over 200 million ounces represented by the contracts that are open in March versus 100 million ounce delivery. Now, if first notice day, we come in at 80, 90, 100 million ounces, I'm going to say that's game over because by the end of the month, it's going to be way more than 100 million ounces. And where's the silver going to come from to deliver?
Yeah, and especially as now we're running into, I think what's really causing the COMEX the issues, and I know we've been looking at this for a lifetime. Essentially, what they used to be able to do, as you say, is that they would take the short side, collude, and then know where everyone's margin position was, and literally make it very unattractive to complete that purchase by literally taking it down beyond a certain percentage where you think, maybe it's going to go down further. I'll cash settle and buy later. It's all changed. It's all changed because they don't set the price anymore. It's being set in physical exchanges in Shanghai and Western facing free trade zone of gold and silver corridors that are 100% backed by physical. So these guys must love it when the COMEX starts discounting gold and silver, especially silver, because you can't, while you can EFP a gold position and where it lands at a fix, just the 3 to 5 tons that lands at a fix is a first tier asset, has to be Basel III compliant. The other 800 tons that trade that day don't have to be. So, but silver, the incentive to actually go to the back door, not EFP it, because the minute you EFP silver into London, it becomes an unallocated position, which you then have to negotiate a higher price for. So that means you have to literally load it out the back door of the COMEX. So you can't just shove it across the blue center line and call it delivered like they used to. It's leaving. It's actually leaving.
During the interview, BillHolter states that gold and silver futures were originally created to manage and suppress precious metal prices by shifting demand from physical metals into paper contracts. Holter further expresses that the rise of Bitcoin also diverted capital away from physical gold and silver. Meanwhile, AndrewMaguire predicts that markets linked to the Shanghai Gold Exchange could eventually challenge paper-based pricing on COMEX as demand for physically backed trading grows. Recent developments in the market appear to support those views. Reports show that physical silver inventories on COMEX and Chinese exchanges have been declining sharply, with registered silver stocks falling to multi-year lows as investors increasingly demand physical delivery instead of paper contracts. At the same time, analysts note that the gap between Western paper-priced markets and Asian physical markets has widened, reinforcing the growing importance of exchanges connected to the Shanghai Gold Exchange in global price discovery. Let's jump into the interview.
Back in the mid-70s, when they created the futures contracts, they were created, and actually, I just posted this on my site 2 days ago. Data had put out a press release back in 2017 where there was an intercepted cable that talked about the origination of the COMEX futures contracts, and that the purpose was to be able to control and suppress the price of gold and silver. It worked as a relief valve, if you will, on the pressure of physical buying of gold and of silver. Now you can add one more layer on top of the suppression, and that was the ETFs, GLD, SLV. If you look at their prospectuses, they do not have to own physical gold. They do not have to own physical silver. They have to own, they can own physical metal, but they're also allowed to own contracts. And when this came out in 03, GLD, and then I think SLV came out a year later or 2 years later, right off the bat, I said, this is a pressure relief valve. It makes it easy for somebody to point and click in their brokerage account and purchase GLD, purchase SLV, and say to themselves, okay, now I'm hedged. I own gold, I own silver. The only problem is that's not true. You don't own gold, you don't own silver, you own contracts. You have a paper conduit to your ownership of the metal. So what it did was it steered what would have been physical buying, cash and carry, you buy it, you take delivery. It took some of the pressure off of that and diverted funds into the ETFs. Now there's one more layer, and not too many people have talked about this, but I fully believe this, that the cryptos themselves were also a pressure relief valve for investors who wanted to get out of fiat. What they did was they've offered another avenue to get out of fiat and into something. I guess when I say something, what is Bitcoin? What are cryptos? In my opinion, they're digital air, and when the rug gets pulled, those are going to be zeroed out. So in the end, you either own physical gold, physical silver, or you don't. If you own the ETFs, you don't own gold or silver. If you own crypto, like I said, I don't know what you own. In my opinion, it's digital air. But all three of those instances were all used to suppress the price of gold and to suppress the price of silver. And oddly enough, gold and silver, since January of 2000, have been the best asset class to own.
Yeah, and I think it's so interesting. You talk about ETFs. I mean, it's so good you bring that up, because people often take at face value, thinking, well, it must be audited, it must be legitimate, and they haven't read the prospectus that you refer to, where it's possible to short sell. So if you can short sell an ETF, if there's a derivative crisis, when the derivative crisis blows its head up, the very reason you bought what you thought you bought gold and silver for was what it should say on the box, which is to protect you. Well, how do you know? You're going to get bailed in to the balance sheet of a bank you've never looked at, who has borrowed silver and can't pay it back. What do you think is going to happen to you when you look at that and say, hey, bail-ins, we've had bail-ins before. You don't know they're coming. You wake up and and bail-ins, and we've talked about this before, Bill, you've been talking about it for years. Bail-ins are everywhere. They're sanctioned to be everywhere on this globe, Western globe. So people don't think about what you're just talking about here, and they invest in ETFs. The Shanghai Futures Exchange should be the tradable side, the hedging side of your physical market in the SGE. It should actually have a practical level. And so what they've done is they've increased margin limits. They've got rid of all of in fact, I understand that there's probably people going to do jail time over there. It wouldn't surprise me. But as you say, there's some serious stuff going on. They slapped it shut because they value the whole system. So what we were just saying a minute ago was really what the PBOC wanted to do was restabilize the functional hedging tool that the Shanghai Futures Exchange was designed to be and got taken advantage of.
Well, isn't that what BRICS is all about anyway? BRICS wants free, fair, and real settlement. They want a real currency. They want they want a real futures market to their cash market. And I have no idea whether this is correct or not, but finance or international finance is a war, if you will. And China understands, if you and I understand that there's a shortage in silver, they understand that there's a shortage in silver. They know more than we do. What they are, what I'm getting at is by shutting down these rogue traders in the futures market, they want real markets. They want Mother Nature to take over because they know that Mother Nature turns the Western world upside down without them firing a shot.
For much of 2025, silver and gold rose higher on factors including persistent inflationary pressures brought on by Trump's aggressive tariff announcements and the ongoing geopolitical risks in the Middle East. The commodity's price uptick also came on the back of very strong silver investment demand. If physical demand continues to rise while exchange inventories keep shrinking, could the silver market reach a tipping point that forces a major revaluation of both gold and silver prices worldwide? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.